All right. Welcome back for the first part of chapter 26. So let's talk about the IRS, right? So the IRS is the agency of the federal government that is responsible largely for certainly the income tax process in the United States. So IRS is a bureau of the U.S. Treasury Department. It has certain powers. It can request to see your books and records, and taxpayers are required to keep such. If a taxpayer meets the record-keeping requirement and is able to substantiate their income and deductions properly, then the IRS bears the burden of proof in any sort of assessment. But the taxpayer must have cooperated with the IRS, at least in part. The IRS can assess tax, but it needs to send what's called the 90-day letter. Now, the actual assessment process is way more complicated than just that. The IRS has collection powers. They can place a lien on property, they can garnish wages, and they can seize property as well. So if you don't pay, they have a way to squeeze the money out of you. So because our system is largely a voluntary reporting system, and we could debate that philosophically because there's so much informational reporting that's attached to filing a tax return these days. But let's work under the assumption that it's voluntary. The way that the IRS enforces some degree of compliance amongst the public is it does audits. But not every tax return gets audited. The IRS technically does not disclose its audit selection process, but we know from former employees and what they have disclosed that they use a mathematical formula to select returns. That's often called the DIF method, where they think of it as they're looking for red flags on your return. So things that might contain errors, things that might yield a substantive amount of additional tax revenue, they're going to pay attention to. Most audits of individuals start about 2 years following when the date the return is actually filed. Largely, if the return isn't audited within that time period, it's going to remain unaudited because, of course, that statute of limitations starts running and they only have 3 years to begin with. Currently, audit rates are extremely low. They are less than 1%, but that's a little bit deceptive because the higher your income, the more likely, the more probable you'll be selected for audit. Again, that's probably because it yields a substantial amount of additional tax revenue. They're going to look at these returns, try to find the probability. So certain taxpayers are more likely to be audited, those with gross income in excess of $200,000. Self-employed individuals with substantial business income and deductions are more likely to be selected. And cash businesses where the potential for tax evasion is high. So think of like your laundromat or, in the old days, restaurants. But everyone pays with cards these days, so the number of cash businesses is shrinking. If a taxpayer's been audited in a past year and the audit led to an assessment of substantial deficiency, right, more money, the IRS will often audit subsequent tax returns as well because they found an area that's rife for collection. So here's a chart that kind of shows what the percentage of individual returns that are examined looks like, and you can see obviously that the more income you have, the higher the probability you're going to be selected. But you can also see a downward trend with all taxpayers. So you probably heard that the IRS got a pretty hefty chunk of funding in 2020. So that's in order to start to reverse some of this downward trend in audit rates, because presumably they'll collect as much as they cost. You can make some observations about your risk of being selected for audit. If your informational returns aren't for the most part, in agreement with what you've reported. So that's strange. You know, you got a 1099 that reported income of $20,000 and you strangely only reported $1,000. That sort of matching is likely to trigger audit. If your itemized deductions are in excess of norms established for various income levels, then the probability of the audit increases. Well, that's weird. You've got $30,000 worth of adjusted gross income, but you have a $50,000 charitable deduction, that sort of thing. The IRS actually gets information from a number of outside sources, other government agencies, news items, and informants. So there is a whistleblowing program that offers awards to informants who provide information concerning businesses or high-income individuals. And they're generally paid out of the taxes recovered out of whatever that informant has provided. There are three basic kinds of audit. A correspondence audit. This includes when a return is checked for mathematical accuracy, or some sort of clearly erroneous deduction, you know, like the decimals in the wrong place kind of thing. You'll get a letter. That's what a correspondence audit is. Several months after filing, when the matching process is starting to get complete, when all the 1099s and W-2s and other information are trying to be verified with what's actually been reported, that might trigger, hey, we noticed you didn't include this income or these wages, or it didn't agree to whatever. Get a letter that says that, that says, hey, we think you're wrong. Here's what the assessment is. You can either pay it or send us a letter back that says why you think we're wrong. Office audits. This is when, it goes to the taxpayer's office or place of business. They're frequently limited in scope. These can be conducted. Sorry, those are field audits. I'm clearly showing my fatigue. Office audits are when they're conducted at the IRS. So these are limited in scope, and they occur very infrequently post-COVID. Taxpayers generally asked to bring some items in, right? So, hey, come into the office. We're going to ask you to substantiate these items. These are the ones you see in television and movies all the times, but they're not very common. A field audit is actually more common, and this is when the IRS comes to you. And certainly for corporate returns, large business returns, you tend to get field audits where the IRS shows up at your business, asks for a conference room, and then spends the next 6 months in there. I'm kidding. It varies how long they spend. For large corporations, they're there year-round. All right, there's a number of penalties that can be charged against a taxpayer. These are used to promote compliance with the tax law, right? So, hey, if you make a mistake, it's no big deal. Well, if that were the case, then human nature is that we would all underreport our income and wouldn't pay our legitimate amount of taxes. We already have a rate of that's too high to begin with. So tax penalties can involve both criminal and civil offenses. Penalties provide for fines, maybe imprisonment. That's not all that common. Civil penalties are collected in the same manner as other taxes and are just monetary, right? So, you committed this penalty, we're going to charge you this amount. Ad valorem penalties are additions to tax that are based on a percentage of the owed tax. So, you underpaid by $10,000, we're going to make you pay 5% of that. Assessable penalties include a flat dollar amount. So a lot of times those are minimums, right? So the minimum penalty for something might be $400, and then it might be a percent above that. So we're going to talk about two high volume, but not high priced penalties. So there's not a lot of money that exchange hands, but these are common taxpayer penalties. So lots and lots of particularly individual taxpayers run into these. And this is failure to file a tax return and failure to pay a tax return. So the penalty for failure to file is 5% per month up to 25% on the amount of tax that's due. The minimum penalty in 2022 is $450, and I think it's $485 now in 2023. And that minimum penalty only applies if your failure to file extends beyond 60 days. So if you're late by more than 60 days, then that minimum penalty kicks in. Otherwise, it's the percentage penalty. Failure to pay the tax that's due is 0.5% per month. Again, up to 25% on the amount of the tax that's due. So let's say that you don't owe any tax and you fail to file and you fail to pay. Well, you can see there's actually no financial penalty for that situation. Because remember, they're both 1% of the amount of tax due. And if you don't owe any tax, then you don't owe any penalty. So let's do an example. Nancy filed her 2022 tax return 3.5 months after the due date. She failed to request an extension. So she's late. The tax due was $2,000. So first we'll calculate her failure to pay penalty. That's 0.5% times 2,000 times 4 months, because you round up the number of months. So 3.01 months would be treated as 4 months. So think of it as 3 months and 1 day is 4 months. So 4 months is $40. Let's calculate her failure to file penalty. That's 5% times 2,000 times 4 months, or $400. When you are assessed both of these penalties, you are permitted to reduce your failure to file by the amount of your failure to pay. So you can see her net failure to file is only the $360. Because she was late for more than 60 days, the minimum kicks in at $450. And so since $450 is in fact the minimum, and that's more than her actual penalty, she has to pay the minimum. So the minimum $450 plus her failure to pay penalty of $40 is $490. So that is the taxpayer combined failure to file and failure to pay penalty. So again, obtaining that extension for filing the tax return doesn't extend the due date on which taxes must be paid. The penalties above can be eliminated if there's reasonable cause for failure to file or failure to pay. Oh, I got hit by a bus on the 14th. I was going to file on the 15th. I ended up in the hospital for 3 months. That sort of thing. Reasonable cause for failure to pay is presumed under the automatic 6-month extension. Failure to file penalty is reduced by any failure to pay penalty for the same month, and we talked about that. So some reasonable cause. The taxpayer worked with a competent tax advisor in good faith, and that they said, "Oh, I thought the tax advisor was going to do that," and they never did. The facts were fully disclosed to the advisor, so there was no secret, and they just didn't do it. The taxpayer actually relied on the advisor's judgment in filing the return. Lack of reasonable cause was when, I just didn't know it was due then, right? So kind of that ignorance of the law doesn't get you there. Illness that didn't incapacitate them from completing a return. So, I felt sick, I just didn't do it. Or refusal of a taxpayer's spouse to cooperate for a joint return. None of these are reasonable cause. And again, ignorance or misunderstanding is never going to get you there. There is a one-time get-out-of-jail-free card available to most taxpayers. It's called the First-Time Penalty Abatement Program. This is largely used by individuals, kind of that first time. If you write a letter and you're like, "Oh, I'm so sorry, I screwed up," they'll often waive those original penalties. There are additional accuracy-related penalties that are 20% of the portion of tax that's underpaid due to either negligence or disregard of the law, due to a substantial understatement of tax liability, a substantial valuation overstatement, or a substantial valuation understatement. The penalty applies only if the taxpayer fails to show a reasonable basis for the position taken on the return. And note that the taxpayer standard is going to differ from the tax preparer standard that we are going to cover later. So for purposes of the accuracy-related penalty, negligence includes failure to make a reasonable attempt to comply with the tax law. So the penalty also applies to the extent there's disregard of the rules or regulation, whether it's careless, reckless, or intentional. And the penalty applies to all taxes except when fraud is involved. And this penalty, again, can be avoided upon showing reasonable cause. All right, so there's also a penalty for a substantial understatement of tax liability. This occurs when the tax understatement exceeds the larger of 10% of the amount due, or $5,000. For a C corporation, a substantial understatement occurs when it's 10% of tax due, but at least $10,000 or $10 million, whichever is less. So the penalty applies unless the taxpayer has substantial authority for the tax treatment of the position that's taken on the return, or if there's a reasonable basis for the return position and it's disclosed by attaching a Form 8275. There's penalty for the overvaluation of an asset. The penalty is 20% of the additional tax that would have been due if the correct valuation had been used. It applies if the valuation is 150% or more of the correct valuation, and then it's doubled if the valuation is overstated by 200% or more. Penalty applies only when resulting tax underpayment exceeds $5,000 or $10,000 for C Corps. And then lastly, another popular one is the failure to pay estimated taxes. This is a penalty imposed for failure to pay your income tax during the year. It applies to individuals, corporations, trusts, and estates. It's based on the rate of interest that's in effect during the deficiency assessment. It's not imposed if the tax due for the year is less than $500 for a corporation and $1,000 for all others. So for individuals, they're required to make estimated tax payments on the 15th day of the 4th, 6th, 9th months of the current year and the 15th day of the first month of the following year. So again, since most are calendar year, that's going to be April 15th, June 15th, September 15th, and then the following January 15th. Corporations, on the other hand, their estimated quarterly tax payments are due on the 15th day of April, June, September, and December for a calendar year, and then, the 4th, 6th, 9th, and 12th months after year end, or of that tax year, if they're a fiscal year end. The penalty for failure to pay estimated taxes is the difference between what was paid and the lesser of. This is for individuals. 90% of the current year tax. So if you pay 90% of the current year tax, you're fine. If you pay 100% of the prior year tax, you're fine. Unless your prior year AGI exceeded $150,000, then your required payments for the prior year needs to be 110% of that prior year tax, or 90% of the tax on an annualized income basis. And we'll talk about that in a little bit. Corporations underpayment is the difference between what was paid and the least of the current year tax, the prior year tax, and again, the tax on annualized income. So in this case, think of it as 100% of current year tax, 100% of prior year tax, or this tax on annualized income that we're going to get to eventually. Now, this prior year alternative only applies if the prior tax year was a full 12 months. It wasn't a short year for some reason. And it was a non-zero tax amount. So you can't have had a loss in the prior year or not had business basically in the prior year. For large corporations, which are those with taxable income of $1 million or more in any of the 3 preceding tax years, you can only use the prior year alternative for your first quarter installment. And then after that, you have to either use the current year or the tax on annualized income computation. I tell you what, we're going to stop right there, and then we'll do corporate estimated tax calculations.